perspective of the UK's financial markets, there's very little macro news of note. And even on the global stage, the main features will be the release of the minutes from the latest meetings of the US Federal Reserve and the European Central Bank. They're due on Wednesday the 9th and Thursday the 10th of October respectively, and economists will pore over those for any clues on future policy decisions. Now, the Fed's already cut rates twice, and the European Central Bank has done so once, at least for its deposit rate, if not the headline refi rate, and it's also returned to quantitative easing. The direction of travel at both therefore seems clear. The issue is rather how far and how fast they may choose to go. Other than that, the increasingly vituperative debate over Brexit will doubtless continue to hog the headlines, especially as the EU summit in Brussels on the 17th to the 18th of October is drawing near. But since not even the Prime Minister seems to know what's coming, it'd be foolish of me to pretend that I've any insight here, and dangerous for investors to try and second guess the possible outcomes. We'll therefore move swiftly on to the corporate news, when we'll receive trading updates, interim or final results from a select number of large cap stocks, as well as a good few mid and small cap names. They include Ferrexpo, Electro Components and Hollywood Bowl on Tuesday the 8th of October, gambling and bookmaking services provider GVC and recruitment firms Page Group and Robert Walters on the 9th, and packaging giant Mondi, house builder Countryside Properties and retailers Dunelm and Elm Brown on Thursday the 10th. But the company which could cause the biggest fuss in the week ahead just might be easyJet. The airline is due to publish a full year trading update on Tuesday the 8th of October, ahead of the release of its actual full year figures in early November. Now, as we can see here, the share price is forging a bit of a rally, having consistently lost altitude for most of 2019. It's been a pretty tough 18 months or so for the airline industry overall, especially in Europe, for a variety of reasons. Now, they include a doubling in the oil price from its 2016 lows, soggy consumer confidence across the UK and Europe, Brexit, where under EU law UK-based airlines could lose their licence to operate and access to Europe's Open Skies Agreement if their shares are more than 50% owned by non-EU residents, drone attacks at Gatwick last Christmas, and above all, increases in industry capacity and competition, especially on European short-haul routes. Now, that said, this brutal combination is beginning to take its toll. This is the S&P 1200 Global Airlines Index since its inception in 2010. Note how it peaked in late 2017, some 2 years ago. Thomas Cook Airlines is just one individual casualty, albeit an extremely high-profile one. Other airlines that have suspended operations, gone broke or entered liquidation include Air Berlin, Monarch, Flybe, Primera, WOW, Cobalt, XL Airways, Adlazur and Adria. Now, both Willie Walsh at British Airways parent International Consolidated Airlines and Ryanair's Michael O'Leary have both said they expect more failures in the coming months. And that may be one reason why easyJet shares are trying to rally, as all of those failures may be an opportunity for the survivors. The failures may reduce capacity, or at least present a chance to acquire it and develop more scale and routes, as easyJet's doing at Tegel Airport, having snapped up Air Berlin's routes. Now, at the third quarter stage back in July, easyJet's chief executive Lohan Ljunggren also offered some reassurance about the Brexit situation. 50.6% of shareholders were already EU-based, and the firm did say it would consider suspending the voting rights of some shareholders on a last-in, first-out basis to make sure that it stayed above that 50% plus one share threshold. Hopefully that means analysts and investors can now focus on the operational performance when Mr. Lundgren gives an outline of performance in the financial year that ended in September. The key factors to watch include capacity growth. easyJet expects a 7% year-on-year increase in the second half and 10% for the whole year. Second half revenue per seat is expected to drop slightly on a constant currency basis. Revenue per seat is expected to drop at a mid to high single digit rate did drop at a mid to high single digit rate in the first half. Then cost per seat, excluding fuel, well, that's expected to be down for the full year on a constant currency basis. Then Berlin, well, that's now expected to be in loss for the whole year. Fifthly, fuel bills are expected to rise from 1.15 billion to around 1.4 billion pounds thanks to higher oil prices. And as we can see here, fuel is a huge swing factor. It's represented around a quarter of both sales and total costs over time. And finally, sixthly, currency movements. They're expected to hit profits by about £5 million. So, adding all of those 6 factors up into the headline pre-tax profit number, we can see here that the second half is always the most important one, since the first half's usually in the red for seasonal reasons. Now, in the first half, easyJet lost £275 million. That implies a second half profit of £693 million because for the full year, analysts are expecting pre-tax profit of £400 to £440 million. That's down from last year's £578 million on an underlying basis, which excludes £133 million of exceptional costs relating to IT spending and also Berlin Tegel. Now, in the unlikely event that Mr. Lundgren gives any stay for the fiscal year to September 2020, the year that's just begun, analysts are currently expecting an improvement in profits to around £460 million. Thank you for watching, and I look forward to seeing you next time.